All right. Welcome everyone to our Wednesday workshop with New View. Today we are talking about building a hedge fund allocation. A lot of people don't realize that this is an alternative investment asset that you can use your self-directed IRA to invest in. Before we get started, just a few things. So New View serves as a passive IRA custodian. We don't give any financial advice. We're not CPAs or any advisors, but we custody different types of IRAs, education savings accounts, health savings accounts, solo 401ks. You would need a self-directed IRA custodian if you're interested in investing in what's called the alternative asset space. So what is self-direction? It's really just a marketing term. It gives you the ability to choose your investments. You don't have to have a financial advisor to help you. You can pick and choose what you want to do with your money. This is outside of the stock market. So it gives you an opportunity to diversify your retirement portfolio and to build your wealth. So these are the benefits of self-direction. Diversification, number one, like I said, there's many different types of assets that you can purchase. The things you cannot invest in are collectibles and life insurance, but that still leaves the opportunity to tons of other types of alternative assets you can invest in. Another reason you want to self-direct is the tax savings that comes along with it. Now, if you're using an IRA like a Roth IRA, it's going to grow tax exempt and you can take those funds out tax free. If you're using a traditional IRA or a SEP IRA, the way that works is it's going to grow tax deferred. So you're also investing in things that you might already be investing in with your own cash, like real estate. Maybe you're doing private lending or buying mortgage notes. But point of doing it in an IRA, it's like I said, the tax savings that comes along with that. So invest in what you know best. So these are the types of plans that you can use to self-direct. You have personal plans, your traditional IRA and your Roth IRA. There are some differences. So a traditional IRA, you can contribute up to $6,000 a year. It's not too much, but most people do get started with a traditional IRA. Reason being, if you left an employer and you had a 401k, a 403b, or a TSP, any types of those employer plans can be rolled over into a traditional IRA because most of the time it's pre-tax dollars. And then that gives you a nice little jump start and you can start using those funds on top of the contributions you might want to make to the traditional IRA. That gives you more buying power to start making these types of investments. The next most common personal plan is going to be the Roth IRA. Roth IRAs are for those people that prefer to pay the taxes now and let their retirement grow tax-free and be able to take that out tax-free. Another cool thing with the Roth IRA, it's not subject to what's called an RMD. When you reach the age of 72 years old, you're required to start taking distributions from your IRA. In a traditional IRA, you have to do that. But in a Roth IRA, you are exempt from that RMD requirement right now. But there's always changes happening. But right now, there are no RMDs for Roth IRAs. It also has a $6,000 contribution limit each year. If you're over the age of 50, both these plans have an additional $1,000 catch-up contribution. Then you have your employer plans. So anyone listening that might be an entrepreneur, own a business, or they're self-employed, maybe a sole proprietor, these are the plans you might want to look at because they have higher contribution limits. A solo 401k is a pretty powerful plan because you can contribute up to $61,000 a year. If you're over the age of 50, there's an additional $6,500 catch-up contribution. Now, in order to be eligible for the solo 401k plan, we call it a solo QRP here at NewView. You must be self-employed with no common law employees. You can have business partners. As long as everyone owns over 5% in the business, they would be all eligible plan participants in this 401k plan. Then you have your SEP IRA. That's also a $61,000 contribution limit. The way that works, it's 25% of where your gross earned income is at the end of the year can be contributed to the SEP IRA. Now, that is similar to a traditional IRA. The way it grows tax deferred. So what does that mean? It's based on when you take the money out after the age 59 and a half years old, you reach retirement, and you start taking funds out as a distribution, you're paying taxes on that distribution at that time. That's how the traditional IRA works as well. So it's tax deferred. Going in, it's tax deductible when you make the contribution. So that's something you want to discuss with your CPA or financial advisor and figure out, what plan or what strategy works best for you. Then you have your simple IRA. If you own a business, a small business, this plan might work good for you and your employees. It is $14,000 a year you can contribute personally. And then there's also an employer match up to 3% of whatever your earned income is. The employer can match up to 3%. If you're over the age of 50, there's an additional $3,000 catch-up contribution. Now, all eligible employees would also be eligible for the simple IRA benefits, and the employer must match at least 3%. There are specialty plans. These are education savings accounts and health savings accounts. So the way the education savings accounts work, it's $2,000 you can contribute each year, but the contributions can only be made up to the age. So this is for your children or grandchildren. It's college savings, but it could be contributed up until they reach their 18th birthday. It can be used for anything like tuition, uniforms, books, let's say student housing, laptops, internet, anything that would fall under education. 2000 doesn't sound like a lot of money, but the way it works is, if you have multiple children, you open these accounts, you can partner multiple accounts together. That gives you more buying power to be able to make these types of investments. And then all these plans are growing together. Health savings accounts as well. Most people who have these plans don't know they can invest this money. They make their contributions, they pay their bills, medical expenses out of the health savings account. But if they invested this, it can grow exponentially for them. They could partner with some of these other investments that they're making. They can take the medical expense receipts later on when they're ready to and cash that out and take it out tax-free. So if your plan only covers you personally, you can only contribute $3,650 a year. If you have a family plan, it's $7,300 a year. If you're over the age of 55, there's an additional $1,000 catch-up contribution. And the way this is taxed is going in, it is tax deductible, and then coming out for medical expenses only, it is tax free. So it's almost like the best of both worlds. I really like the health savings account. If you're not sure if you're eligible for a health savings account, you want to check with whoever your medical plan provider is. If you have a high deductible health care plan, more than likely you would be eligible for a health savings account. So these are the most common types of assets that clients will invest in. Private entities, so that will be like syndications, LLCs, joint ventures, trusts, hedge funds. Then you have real estate. Many clients like to invest in real estate. It could be offshore real estate. It could be land. It could be short-term rentals or long-term rentals. Cryptocurrency, we see clients buying that. They put their undirected cash in there, and it's doing well, then they're happy. But cryptocurrency is one of the things you have to keep an eye on. It might be a long-term play. It's kind of like the stock market. It is up and down. So always do your due diligence before you invest into crypto and any other investment, of course. And then you have notes. So if you're doing any private lending or you're buying existing notes, there could be performing notes, non-performing notes. You can do secured notes or unsecured notes. A secured note is secured by some type of asset like real estate. And if the borrower doesn't pay you back, you can foreclose on that piece of real estate, and you end up with the real estate versus the interest that you were promised on the note. And unsecured notes, they don't have any collateral that is secured. All right, so we're going to go ahead and move forward. Mark Kress is our guest speaker today. Mark brings decades of portfolio and risk management experience to manage assets and hedge fund portfolios for family offices. He helps to maximize risk-adjusted returns. He's a wealth of knowledge. I'm real happy to have him. This is a topic we have not covered in the past. Hey, Mark, how are you?
I'm doing well.
Thank you so much for joining us and taking the time out of your day to speak with our audience. They're pretty excited to learn from you and your experience. I'm going to let you go ahead and take over from here, and then I'll meet you at Q&A at the end.
Sounds great. Well, welcome to you all. Let's just do a little bit of a quick view of the hedge fund space as it exists. As far as an agenda is concerned, I just wanted to start off with a little backdrop on who I am, and then talk about kind of what is a hedge fund, and then finally how I approach building a portfolio of hedge funds. And at the end, I think we have a curated Q&A, which I'm looking forward to. As far as backdrop, I've been in this hedge fund space for at least 25 years now. But I was a hedge fund manager, a portfolio risk manager for about a decade. It was global long-short equity. My job was to help manage about 5 different strategies, trying to manage the risk with individual equities that I would optimize in to kind of manage the risk profile of each of the strategies, along with I managed my own market neutral strategy. But I think the backdrop on that experience that's helped me more recently is, return is great, but risk has to be managed. So I got a good flavor for that, and I have use of some great tools to make that happen. The other thing is I found out how hard it is to actually add value in the long short equity world, especially if you're working with large caps. So finding alternatives to long short equity, has been fruitful in my experience, and I'll address that going forward. So in 2013, I transitioned and I started working with family offices. Now, family offices are like the RIAs for ultra high net worth people. And what I found was that you would think they're kind of the sophisticated side of the investment world, but a lot of them needed a better mousetrap, especially from a risk adjusted standpoint. So what I was doing was helping them kind of understand more of what they owned. Doing asset allocation, kind of figuring out what they needed to own, and then doing due diligence on managers to kind of fit what they needed. What I also found was that I worked for a family office for a year, but there were other family offices that needed kind of the same type of assistance. So I created a consultancy and worked with maybe 20 different family offices, pretty much in the same vein. And it was about 4 years ago, one of the families said, put your money where your mouth is. You talk about absolute return, you talk about diversification, and how important that is to asset allocation. Why don't you go ahead and put together a hedge fund allocation and see how it goes. So it went well. So 2020 and 21, they were up like 24.5% with like a 10% vol. 10% annual variability, so which is about half the market. So what I did is I parlayed. I said, why don't I create a structure where other people can get involved. And Jan 1 of this year, I launched a fund of funds using a very similar methodology. So that's my backdrop. I think it's always important to also just understand what is a hedge fund. I think there's a lot of misnomers about what hedge funds are and aren't. The history goes back, I think, to 50s and 60s, where there were mutual funds that existed, and they were governed by ERISA, and ERISA had some very strict rules on how people could manage mutual fund money. So I think wealthier people or some of the talented money managers felt like they were just kind of working off one side, only one side of the trade. There were great short opportunities, so they decided to create a structure where they could go long stocks and go short stocks. And it's very simple structure. It's a limited partnership. They pool money into this limited partnership, and based on your contribution, you own a percentage of that limited partnership. And on top of it is a general partnership, and the general partnership is the manager, and they manage the limited partnership in exchange for fees. The strategies are pretty much governed by the subscription docs. So the subscription docs outline what they're going to do in this limited partnership, and for as far as NewView is concerned, a lot of times they're not the most tax efficient vehicles. So IRAs are a great place to put hedge fund portfolios because you're not paying taxes on anything until you withdraw. So that's a brief. Everything is kind of the one thing that separates hedge funds from a lot of things is liquidity. So primarily, hedge funds are investing in liquid instruments. So they often have either monthly or quarterly ability to withdraw, which is nice to have. And I think the purpose and the strategies have evolved over time. Historically it was a lot of long short equity, but I think now it's only about 45% long short equity. And then there's a lot of other different types of strategies that are out there that are making money. And I think most importantly, they're making money without being dependent on the stock market or the bond market. So uncorrelated returns, which is a great addition to an overall asset allocation. So I do have just one thing to share, which is kind of the general consensus of the types of hedge funds out there. So I just took this off the web. This is how people view the different types. I'm not going to go over them individually, But there's a lot to choose from, which and there are a lot of hedge funds. There's thousands of hedge funds, so it becomes a little overwhelming. Now, I opt to simplify this from a risk standpoint, which is this is my current portfolio, and I kind of do it from a risk standpoint. Might be hard to read, but I have a category for absolute return, which we've discussed, which is uncorrelated returns to the market. There's global macro. I put a separate category for systematic, just to monitor them closely. But I do have long short equity, and I have some long biased equity. So that simplifies things, more of a risk categorization than just an overall kind of what their strategy is. Great. So, the other thing that's happened in the hedge fund space that I don't think has been really great for it is there's been a lot of consolidation. I mean, there's still thousands of small hedge funds out there, but the majority of the AUM is consolidated into some bigger firms, and they have brand names, which is great. But as we'll discuss later, sometimes bigger isn't better as it relates to generating excess returns. So that's the brief of what is a hedge fund. So transitioning, I'd like to talk about my approach. And given the plethora of different types of hedge funds that exist out there, you have lots of options, right? In some cases, overwhelming options. Still we do have a core long short equity contingent, but as you saw with the variety of different funds out there, there's a lot to choose from. And I think I take this from an asset allocation standpoint. So you need to build it with a goal in mind, right? You could probably find a number of hedge funds that are generating income. So if you need an income source, you could probably put together a portfolio of hedge funds that generate income. I think another great thing you can do is you need an alternative to being long the stock market, right? So you can put together a portfolio of long short equity funds that have proven themselves to deliver excess returns relative to the stock market, and get better than equity returns with half as much risk. That's another great option. But I had my own goals in mind and my own biases, and that's the caveat to everything I'm going to say from now on. I kind of believe, and I have believed since probably 2015, that the stock market, the bond market, the real estate market are all overvalued, right? That's not the place you want to be, right? I've been terribly wrong, arguably, for a long time, until maybe this year. But I believe that, and I also believe that there's not a lot of great options to invest in things that aren't exposed to those core asset classes. So in my case, and one of the reasons why the stock and bond and real estate market are overvalued, in my opinion, is we've had free money since 2008, right? And as soon as they turn that free money off, things I think are going to go poorly. Now, I sound like I'm a Monday morning quarterback, but this is what I've been saying for a long time, so I don't feel bad about saying it now. But so I think the market does need an absolute return vehicle that is uncorrelated to the market, and is intended to deliver market plus returns with no correlation to the market, and close to half the risk of equity investment. So that's what I've put together. So and I'm going to go through my process. Again, another caveat about my process is there's not just one way to build a hedge fund allocation. This is just the way I chose to do it, given my backdrop. I do have a quantitative background, so I'm using kind of risk management tools, and I'm using diversification, which I think is helpful. So my general thesis about hedge funds, as I alluded to in the past, is the bigger is not necessarily better. I think the worst thing that can happen to a hedge fund manager is getting more assets under management than they can handle, right? Most strategies out there that are delivering good returns, have limited ability to do so. So when I'm looking for managers, I'm looking for managers that are going to stay small on purpose. That gives them the ability to invest in things that might not be as liquid, it gives them just the ability to be nimble in a marketplace that's moving very quickly. So they call it a soft close. So I'm looking for managers that want to stay small and they're planning on closing to new investors at a certain stage. And then they sometimes have a hard close where they're going to start giving back money, which would not be ideal, but that happens too. But they're going to stay small on purpose. The other thing I look for is kind of very niche strategies. So people that are making money in the marketplace, different than most. As I mentioned, I do have long short equity, but I also have somebody that trades the trades the energy market, unregulated energy market, or I have a long short equity guy in mining stocks, or I have a SPAC manager. I have some macro guys that do commodities and interest rates. So they're generating returns in very different asset classes than stocks, bonds, or real estate. And I like that category. And I also believe very strongly in diversification. I cover probably 100 funds, probably 40 of them very closely. But putting all your eggs in a couple baskets can be harmful because some funds just don't do well. Arguably this year, I've had some funds that I've owned that have done absolutely terribly, right? But given I manage a portfolio of 15 funds, so they're all relatively equal weighted. So, not one fund can hurt me that much. And I like the diversification benefit of that. I do use, the whole idea is, you can find managers that are, on average about $200 million under management, right? And most of them, or all of them, have 3 to 5 year track records. So they've shown history of doing what they do well. But a lot of them have a lot of risk associated with what they're doing. In most cases, people will kind of shy away from, even if they're generating a 25% return, they'll shy away from a 25% annual variability because they'll see a 10% drawdown in a month. So most people don't like to experience that. So by diversifying across 15 names, you take a 25% return with a 25% volatility. You add that to a 25% return with another 25% volatility. You'll get a 25% return with less vol if they're uncorrelated. And what I do is I do that across 15 strategies. So I'm managing to a 25% return with an annual variability around 9. The stock market currently is trading at an annual variability of about 18. So it's about half the market. So that's my approach. Optimized, diversified, smaller niche strategies. Make sure they're not too big and they can't execute on their strategy, and make sure they're doing something different than the rest of the marketplace. So, the final thing is kind of, what is the payoff, from an asset allocation standpoint? Now, arguably, it's kind of the tale of two tapes, right? So the first tape I'm going to just bring up is at the end of 2021, as you can imagine, right? What's happened to the hedge fund what's happened to the investor over the last decade is, that looks like it's very hard to see. So let me just, I'm going to, I know it's going to be a lot of numbers, so I'm going to just share it a little bit bigger, hopefully. Okay. What's happened to investors over the last decade, it's been tough to get involved in alternatives, so let me just frame this up for you. Hopefully it's not too much going on. I just want you to look at the 60-40 stock breakdown, right? This is obviously without hedge funds. Now, 60-40 over the last 3 years, is up 17%, right? With a 10% annual variability, right? And I'm not sure if you guys are familiar with Sharpe ratio, but Sharpe ratio is just return over standard deviation. So it's how much return you're getting for your risk, right? A Sharpe ratio of 1.5 is phenomenal. Like anything above a 1 is phenomenal. So the 60-40 split has done so well, over those 3 years. it's been hard to justify it. Because if you scroll over to the HFRX Global Hedge Fund Index, which is just kind of an aggregate of all the hedge funds, you can see that their returns are not anything to shake a stick at. They're not that interesting, right? 6.3% return when, a 60-40 split would have done 17. So it's baby with the bathwater, I think, in a way where, this HFRX index kind of captures these large behemoth hedge funds that if you take a look at the Wall Street Journal, you'll see, oh, they're underperforming and they're not justifying their fees, right? And that's exactly what happened, is these bigger hedge funds did not perform well. And there was really no reason to invest in them. So if you take a look to the right of 60-40 to 45, and I just did a 25% allocation to the hedge fund benchmark, I mean, you gave up returns. I mean, you lowered your annual variability, but you gave up a lot of returns. And that kind of lends it to picking better, right? Is kind of shying away from the large funds that don't do well generally, and try to find funds that are doing exceptional, right? So the next column over is including a simulated fund that I put together based on the funds that I follow, right? In this case, you'll see over this period that I'm adding return. So I'm at 21.6 versus 17.4, but I'm also lowering volatility, right? And what lowering volatility means to the investor is that, over time, you're not seeing your portfolio doing wild swings. It's kind of just steady eddy. So you're losing less on big down months, and you're, maybe making a little bit less on the up months, but overall you're doing better. And that's always good for investors to have kind of a smoother return stream. Now, and then of course the Sharpe ratio goes up because the risk-adjusted returns are good. Now, so as I was saying, people got lulled to sleep a little bit because 60-40 has done so exceptionally well. And of course, in the back of my mind, I said, I know this is going to end, and it's going to end badly. So of course, I created a version of this through October, right? And you can see this whole thing flip, right? And hold on one second, let me get that. Of course, I don't have it. Bear with me for 1 second. And I think everybody can attest to some pain as of late, given what's happened in the marketplace. And I've been around long enough where I've seen this happen on numerous occasions, right? 2008, and 2001. But what's been scary about this last 8 months is I'm looking at the year-to-date line, 12/31/2021 to 8/31/2012. What's scary about it is the S&P is down, but also the bond market is down. So that's kind of the double whammy of, and my personal belief is that real estate is going to be the next to fall, which is showing signs. But so that's scary when they're supposed to be uncorrelated. That's why they have such great risk-adjusted returns as of end of 2021. But they've been pretty perfectly correlated with each other for the last 8 months. So that's a scary prospect for most investors, because that's where the bulk of their assets in. So we saw some value to add them as of 12/31/2021, but the value is amplified in this particular market environment where you need something that makes money when everything else is falling. And that's what absolute return vehicles do, is that they're not correlated. So if you take a look at this is the Alpha Diversified Fund Net. This is the fund of funds I manage, but you'll see that the beta on the bottom right corner is 0.13. So it doesn't have a lot of exposure to the S&P 500, and the annual variability is half that of the market, right? But it's still generating great returns. Because I was able to find some exceptional managers that have done a good job. So you can see year to date, it's up 13.7%. Now let's take a look at the year to date numbers, right? So if you had a 60-40 split, you would be down 13.8%. And with the hedge fund index, that's adding value now because it's not down as much. But if you do have something that's actually generating returns in this type of market environment, you can see that you're not experiencing as much of the pain as most people that are in the 60-40. And this goes with any allocation that you're making in alternatives. I would argue that you might want to look for things that are uncorrelated. So another real big difficulty has been venture capital and private equity. I think they're down close to 50% year to date, even though they won't tell you that. But it's been a bloodbath in that particular, because that private equity and venture capital is literally just 2x the equity market if you take a look at their exposure. So they have like a 2 beta, right? So they just pretty much are long equity with double long equity. But the whole idea is to take some money away from your stock and bond allocation and allocate it to something that is uncorrelated with those 2 asset classes, so that you can smooth out your returns over time and not necessarily generate positive returns in a market like this, but at least smooth them out so you're not losing as much. And that is the type of portfolio that I put together with the hedge funds that exist. I mentioned another strategy where you invest in good long short equity managers, right? That I have some long short equity managers that are positive this year, right? What's great about what's happened for them is that we've had some price discovery as of late, where the good companies are getting rewarded and the bad companies are getting punished. So they can actually add value and invest in the right stocks and beat the market. So the portfolio that I mentioned before, which was building a portfolio of good long short equity managers, that has a potential to be up in this type of environment. And then I also have some long short managers that haven't done as well, but I'm diversified across 15 names, so it works out well. So in conclusion, you guys are on the right track. The idea of going to a new view and trying to diversify away from the bonds and the stocks that the SPY and then the bond market, and trying to diversify away from those type of asset classes, I think over the long run is just a great option. You've maybe heard of the endowment model, or these big institutions. They've been doing this for hundreds of years, which is they have a longer term time horizons, but they're making sure that they're not 100% exposed to core asset classes, and they're diversifying. Anywhere from 10 to 30% of their assets are in absolute return type vehicles. So it's still a great time. I think there's still more room for this sell-off to continue. So it's a good time to consider diversifying away from those core asset classes. And I'm happy to take any questions that you might have.
Awesome. Thank you so much, Mark. That was really informative. I know hedge funds is one of those things. It's kind of a scary thing because people don't understand how it works. And I think you really explained it for, an everyday person like myself to figure out how the money is allocated. So we're going to go ahead and open it up to Q&A, everyone that's listening. All of you people live, you can type the questions in the chat and I'll go ahead and read those for you. A few questions that I do have. So what would the process look like if somebody, say they have their self-directed IRA already established and they wanted to add a hedge fund into their portfolio?
I think it works like every other investment, right? So in my particular fund, I have a lot of IRA money coming from different trust companies. And what ends up happening is the individual fills out the subscription docs and they send it to the trust company, and the trust company submits it to the fund manager, right? And when everything is signed off on, the trust company sends the money to the LP, and then the trust company sends the money to the hedge fund, and then you have an investment in the hedge fund, and you're receiving statements every month on how that fund is doing. Okay. So it's very consistent with all the other private investments that you do under New View.
Okay. So typically something like this would fall under a 506C, Reg D filing?
A hedge fund?
If somebody wanted to invest, like, is it limited to accredited investors?
Oh, sorry. Yes, yeah, the vast majority, if not all, you have to be an accredited investor to invest in hedge funds.
Okay, perfect. And then what if somebody wanted to reach out to you? What's the best way for them to reach you?
You could reach me at, I think they're going to post my email, but it's mkress@alphawealthfunds.com.
Okay, perfect. Yep, we
Also
have
on
it
LinkedIn,
posted right here. What about is there a website or anything?
alphawealthfunds.com.
Perfect. All right, everyone. So that's the best way to reach Mark. If you want a one-on-one with him and ask some more questions, you can always do that. Um, if somebody wanted to learn a little bit more about hedge funds and adding it to their portfolio, what would be a good resource for them?
God, that's a great question. You can just call me.
Okay.
No. What is a good resource? Yeah, I'd have to think about that and get back to you. I think one good resource has been the prime brokers. They
Okay.
seem to do a good job of putting together kind of industry rags associated with like what's going on in the hedge fund space, where the money's flowing, who's doing well. HFR, hedge fund research, is kind of the database of all hedge funds. They also put together some industry stuff that talks about the same type of things. Those are the two things that pop in my head, but I have to give that some thought.
Okay. No, that's definitely
The other thing that I do is I attend a lot of conferences. So they're very, very amenable to investors. So alts, God, there's so many of them. There's Context, iConnections, alts. There's an alts group. They provide conferences all over the country, and that you want to make sure it's specific to hedge funds because they cover all alternatives. But if you're an investor, they'll let you come, and those are great places to kind of get up to speed.
okay. Let's see. I have a few questions that came in. How do you select your managers?
Yeah, I've been in the space a long time, so I have a lot of connections in the space, which helps because I'm getting referrals. As soon as you're a quote unquote allocator, you're getting inbound, right? People are reaching out to you. Would you like to look at my hedge fund? I don't find that as fruitful as people that I know that are investors that are telling me about new strategies that they've come across. You might want to take a look at this, take a look at that. As I mentioned, I also go to conferences that are very specific to hedge funds, where I can meet 30 different hedge funds of my choosing. Those are super fruitful, where I can find the kind of the next best uncovered one.
Mhm.
So personal referrals and then these conferences are the two major ones. And I do get the occasional just random one that comes across LinkedIn or email, that I do a deep dive. My program is I have 15 funds. So like right now I'm judging every new manager based on what I already own. So the bar is actually relatively high for who
Mhm.
can get into the program. Initially, it was difficult to kind of put together the 15 funds. But right now the bar is pretty high. So like I don't entertain a lot of new funds unless they're exceptional and they can add value on what I already own.
Okay. How easy is it to liquidate if, say, someone's 72 years old, they have to start taking their RMDs and their money's vested? How easy is it for them to liquidate?
Yeah, I alluded to liquidity as being one of the benefits of hedge funds. But arguably for some people, daily liquidity is what they're used to, right? So monthly liquidity sounds great until you really need it. So no, you do have some limitations on liquidity as it relates to funds, and each fund actually has its own terms. One of my funds is monthly liquidity with 5 days notice, right? So that's about as liquid as it gets in my program. And then some require 60-day notice prior to the calendar
Mhm.
quarter, right? So that's
Wow,
kind of brutal, right?
it
Um,
is.
so it all depends. So like if you are in need of liquidity, I'm also a registered investment advisor. So it might not be the best place to go because like sometimes you're going to have to wait 3 months, 4 months to get your money back,
Yeah.
depending.
And can they do partial liquidity, like I said, just to satisfy
Yeah.
that RMD requirement?
Yes.
Yeah. Okay, perfect. Okay, so second part to that question on how how you select your managers, how long do you track them, and once it's their money's invested, what does your interaction with them look like?
Okay, how long do I track them? Um, I've been covering hedge funds for a long time, so I've tracked most of these funds for years. I started managing, or I started really deep diving into hedge funds to invest in 2019. So I've been following most of these managers since 2019. But I think the question is, how long does it take for me to actually put money to work? Sometimes it's relatively quick. It depends on the fund, right? And sometimes I'm like, yeah, there's no way I'm going to put any money in that fund, right? So no matter how much I look at them, right? Because I don't trust them. Oh, the one thing I forgot to mention, I didn't talk about due diligence. And so I'm going to do a quick tangent. So the
Go for
most important thing, if you're thinking about investing in a fund, is who their administrator is and who their accountant is, right? So accountant is self-explanatory. They do the taxes and the audit of the LP and the GP, right? The administrator is a third party that strikes the NAV. Okay, that's probably confusing, but that does the accounting on a day-to-day basis of money inflows, money outflows, and what that fund is making. That is absolutely critical. Because it is a minefield. Like, there are scammers out there, and you probably see more of those than you do the good hedge funds, because they're the ones making the news. So, but what really separates hedge funds is their administrator. So make sure they have a good administrator, top tier administrator, so that there's a third party looking over their shoulder, making sure everything's above board. Okay, sorry, I digressed. What was the question? I can't remember what the question was.
No, the due diligence piece was really important. I'm glad you covered that. Just once the money's invested, do you have more interaction with the hedge fund
Oh,
managers?
sorry. Yeah, so I'm getting monthly, obviously, performance reports from the hedge funds I'm invested in, and arguably probably 80% of them are sending me some sort of write up on what happened during that month, right? And then some are just kind of not saying a thing and just doing their thing, right? So again, it all depends. And yeah, it just depends on what their strategy is, as how they reach out to their managers. But I'm definitely getting updates on performance and then a statement every month. Usually takes about 15 days after the month end.
Okay. Next question, I think it's more for me. Can you use a traditional IRA to include in hedge funds? Yes, 100%. Any self-directed IRA vehicle can be used to invest in hedge funds. But I do have a question. How about like HSAs, ESAs? Can those be used to invest in hedge funds as well?
Are you asking me?
Yeah, I don't know. I
I
don't
don't
know
even
if
know
there's
what's an
requirements.
HSA. What's an HSA?
Health savings account. It can be self-directed.
I can't answer that. I don't
Okay.
know.
Wasn't sure if you knew the answer to that. So at NewView, you can self-direct a health savings account or education savings account into alternative assets. There are certain assets you might not be able to invest in. For example, like cryptocurrency, they don't accept health savings accounts right now, but it is in the works. So, that's something you always want to discuss, anyone listening, with your financial advisor and see if it's something acceptable. It is a bucket of money that can be self-directed. So, it's something to definitely explore and see if that's an option. You could always create what's called a checkbook control LLC as well, where you can put all your buckets of money into that LLC as members of that LLC and then allocate it towards the alternative investments. So, next question here. Apart from oil and commodities, what assets in alternative investments do you think have scope in short to medium term with equities?
Just repeat the question. So,
Yeah. Okay.
I actually, I'll answer this generally, right?
Okay.
I'm looking for managers that make money, right? So historically, they've made exceptional returns, and they do it in a variety of ways. I think you've
Mhm.
alluded to the fact to what's working currently, right? So what's working currently is global macro, right? Global macro is kind of a catch-all that says they invest in commodities, they currencies, and all kinds of things, right? So and they're taking advantage of price dislocation, right? So the demand for energy is higher than supply, right? And they can get in front of that all day long and make a crap ton of money. Like some of the macro guys are just blowing it out, right? So that's been the right place to be. Now, arguably, I have 23% exposure, right? So I'm exposed to a lot of different things, right? So, long short equity, when the market rallied, did exceptionally well. The macro guys did poorly, right? And this is all by design because I'm exposed to uncorrelated investments. So there is the idea of the flavor of the month and trying to position yourself accordingly. But that's actually taking beta exposure. That's actually taking risk. I'm trying to create something that doesn't take that risk. It's exposed across all assets so that when macro does poorly, something else is doing better, right? When long short equity tanks, something else is doing better, right? I have a 25% absolute return bucket, which means these guys have been making money no matter where the market goes forever, right? So that's just a constant, income stream for the fund. I do not try to play the market or try to position myself for anything. I just want a very diversified portfolio that is intended to make money no matter where the market goes. And I play both sides. But arguably, my long short equity managers on average are beating the market this year, which contributes to return, right? So I'm not going to. Sorry, I didn't really answer that question, but but now I'll answer it very specifically. So, like I mentioned, we have had price discovery in equity markets for the first time in a decade, right? So there are some really phenomenal long short equity managers that are doing exceptionally well in this environment, if you can imagine. So finding those is a great place to be at any time. Similarly, the absolute return managers, with all the volatility that's going on, they've actually provided some great returns. And as I mentioned, global macro, I think will continue because there's just so much dislocation in what's going on in the world. Is global macro still going to continue to perform going forward? Because again, these are just my opinions. We're only going to get more dislocated going forward.
No, I agree. It's a great comment and way to see it. We're evolving right now. People are changing the way they're investing, and I think diversification is going to be the only safe bet for people. Okay, so that was the last question we have. Thanks again, Mark, for joining us. This will be posted on our social media. You can find it on our website, newviewtrust.com. Follow us on YouTube as well as Facebook. That's a great way to keep track of our workshops. If you have questions about setting up a self-directed IRA, you can email myself at iraspecialist@newviewtrust.com. I'm happy to talk one-on-one with you and help you get your funds over here and invest into whatever alternative space you're interested in. So we're going to go ahead and leave it like that. We'll see you guys next week. Thanks again for joining us and have a wonderful rest of the